Add to stage. Can you see me? Can you hear me? Test, test, mic test. Okay, how does this work? Oh, hi. I see there's two people. Pretty sure one of it is my own phone that I'm using to test. Can this be seen? Okay, give me a second. Let me fix this. Right. Okay. All right. So I'm just testing out how the live stream system works. I think I've done one previously, a couple months ago, but that was with my old setup. I can't seem to get the camera to actually connect with. I can't actually get my camera to connect with StreamYard. I'm not too sure why, but I'll test that out over the weekend. But basically, just here to test out the audio and some of the different functions. Give me a minute. Yep. Okay, let's see. Yeah, so I will really learn how to get everything set up by next week. But honestly, this oops. Yeah, this is you see that's why I've been using the fork. Oh, something else. Okay, I mean, I guess while I'm waiting for people to come in, let me just work on this. If we hit 4 or 5 people, then I'll perhaps start talking about what exactly we are doing. But for now, I mean, the general idea is that in the past, when I've invested over the last maybe 7 to 8 years, um, I've done so rather haphazardly. In a way, in a sense, it's not that I don't have any strategy or frameworks that I use, but I've never actually documented it. So basically, what I've done over the last couple of weeks is to uh, work out how I actually found some of these companies, what are some of the similarities, and what were things that I looked out for, things that worked out, things that didn't. And I tried my best to compile all of this into like this Excel file. And I think in the past, I've asked some of you to uh, give me names of certain companies that you wanted me to go through. So rather than just take the companies through uh, by looking at the revenue numbers and things like that, I thought it would be fun to actually uh, go through them with this scoring system, see how they do, and then we rank them accordingly. We perhaps create a portfolio based on these companies and we track them over time to see how they perform. Right. So let me finish this first. Uh, Margins. So I think I'll work on the scoring a little bit later on. Let's see. Oh, wait. This got value here. Leave space here. It's going to be 1, 2, 3. These three. Stick here. Okay, so okay. And then here, gross margins. Oops. Gross margins here are leverage. And I just realized And I just realized that the numbers here need to be 1.5, 1, and 0.5. And then these will be copied down over here because I think later on it will work out fine. Yeah. Because you need to score 1.5 each, max score for this segment over here is 3. Okay, then moving on to debt and goodwill. Oh, this is where I actually need to split debt and goodwill again. So oh wow, United Health is 309 now. Let's take sorry that let me I'm distracted right now by 309. I think how do I use this? Oh, it's over here. United Health 309. How do I where is it? United Health. It's over here. Well, okay, it's I think it's the weeklies. If we look at the dailies, I think the only dip that we saw was earlier this morning, literally over here, when we got back to the 297 range. And then since then, even if you look on the 5-minute chart, everything is up since then. I'm not too sure whether or not the gap will actually fill at the bottom later on, during certain weakness that we have in the markets. But at the end of the day, I think we have already seen, I think based on the filings, if I'm not wrong, Warren Buffett actually made his buy on June 30th. So if you look at June 30th, it is, where is it? June 30th, around here. So that would make Warren Buffett's buy somewhere, if I zoom in a little bit, June 30th, what do you get here? Right. So Warren Buffett made his buy somewhere in the $310 range, which is basically where we are today. And I think that signals to the market that there's some sort of validation of that range in terms of fair value. So for those of you who have been buying down in the 250 range over here, I think definitely you're very happy right now. So I think what we really want to see on the technical level is for it to actually bounce off, come back down, bounce back off this orange line on the daily chart to really show us that, basically they can start to fill this gap up here at 374. But personally, I'm not too much of a technical person myself. Like I don't really look at technicals in very much detail. I think fundamentally we already know this company is very strong. Now later on I'll bring you through why I've actually started a position in this company. I actually doubled. I think it's sold already. Let me take a look. I am pretty sure. Yeah. So I sold. Yeah. So if you take a look at my positions, you can see that United Health I got in. I still have 10 contracts left. The average price is around $20.50, and we sold it at $43.50. Right, so literally just sold it, and I think because of that, I think we realized I basically doubled my money, took out my capital, everything inside there until December 2027. I don't have to touch it if I don't want to, and everything is pure profits from here, right? No matter what it does, and then I can use the money that I actually take out to sell more puts against certain other positions that I actually have a higher conviction in. Okay, so back to the Excel file. I'm so confused how this actually works. I just realized that you guys have been looking at half my face most of the time. Uh, I'm a little bit disoriented. Give me a minute. Okay, remove this. Share screen. Okay. All right, like I said earlier, because there are around 4 or 5 of you here, basically I will just start off the stream officially. So what I'm doing today is a couple of things. I think firstly I need to test the streaming setup after I moved into my new place. Today, I think if you realize the mic sounds weird, camera looks weird because even though I got this cam link somehow or other, I can't connect everything to my computer. So I'll figure that out over the weekend. Okay, so the first things first, I'm going to take you through what I plan to do over the next 2 weeks. So basically, we will be covering 10 companies in 10 days, right? So 10 companies in 10 days means that basically it's around one company a day for every single weekday, Monday to Friday. We will go live every single day covering a company. Now, how we will do it, I think some of you have heard how I've covered companies like Grab, Hims, and Hers, as well as companies like SoFi in the past. I'm not too sure whether or not I can go into detail with every single company because I've only spent around the last 2 to 3 weeks researching 10 companies, and usually it takes me 2 to 3 weeks to just research one company. So I'll do what I can, but I think the idea of it over here, uh, or at least why I'm deciding to do all these live stream, is a way for me to document my thought processes. Because when I started investing all those years ago, 7, 8 years ago, I think 2017, so that makes it nearly 8 years ago. um, I, I've changed how I approach, or my approach towards investing has changed over the years. Um, and I've never really documented that process, right? So I found companies like Palantir. I think I can show you in future that in my other account that my cost average for Palantir is negative $200 after realizing all the profits and things like that. And then, yeah, I think most of you who are, have been following this channel for some time, I also own companies like Hims, like SoFi, and things like that. And so, what I hope to do is to actually reverse engineer how I found those companies, because at that point in time, when I was researching the companies, there were certain things that excite me about the company. Uh, but I think what I want to do is to find something where I can actually repeat the process and to use, similar frameworks to actually find other companies. So whatever I'm building out over here, when people say framework, it's basically just a bunch of words on Excel. Nothing here is, written in stone. What we're doing is that I'm actually building this based on reverse engineering how I identified SoFi, how I identified Palantir. Why I separate these two companies, because I think if you look at normal tech companies as well as financial companies, you can see certain metrics tend to differ. So, for example, cash flow will be one instance where when you're looking at a financial institution, I'm not talking about like a PayPal and things like that, but when you're talking about a bank like SoFi, uh, usually cash flows are not really a good indication of how profitable they are because of the movement of their loans on their balance sheet and things like that. And so that's why there's a difference over here, but I'll work that into the model. So basically what I've done is that I've tried my best to think about why I bought Palantir, what were the things I was looking for, and then to score them accordingly. So if I'm going to take you through, let me zoom this in a little bit. I'm not too sure. Can I zoom this in? Will it become bigger? Yeah, I will. So there are about 10 different segments, and it goes from top down view. And the first thing that I like to look at when looking at a company is their total addressable market. So if the TAM is 10 times or more greater than revenue, and the TAM is growing at 10% CAGR, not their revenue, then we'll score them accordingly. And then there must be expanding new use cases with active disruption. So for example, AI is a TAM that has expanding new cases every single day, right? We're always finding new things to use AI in the way that we apply it to our daily lives and to solve real life problems. And that's exactly what we're looking for. And then we'll score them accordingly. And then at the same time, the business model needs to be simple to explain. And I think we already know by now that people tend to like companies with recurring revenue or a repeat purchase model, right? So that's why subscription based revenue is actually very important for a lot of these companies. And then from there, we go on to talk about the moat that the company has. These are things like switching costs, network effects, low cost advantage, and economies of scale. So just to be very clear, low cost advantage, it means that because of certain relationships the company has, it could be with suppliers or it could be because of being vertically integrated, that they have certain low cost advantage that other competitors competitors may not have. However, economies of scale is something like Amazon, right? Because Amazon is such a huge company, they offer same day delivery. If someone else wants to come to market and compete with them, they will need to actually to basically to invest a large amount of money to in order to catch up with them. Or it could also be because of the scale of the business, they can get certain things at cheaper prices and things like that. So those are economies of scale. Intangible assets can be modes as well. Brands like Apple, like I think if you're talking about how good a certain hardware is, I think a lot of people like to argue that the specs of certain Android products are better than Apple. But at the same, but those people like me who are buying Apple, no, even if you know that Android has the better camera and things like that, you're still going to go out and buy the next iPhone. So that's brand. Processors could be like Tesla, right? When Tesla actually builds their cars, they actually build the machine that builds the cars, and not everybody does that, right? So they have certain processes that they do that differentiates them from their competitors, and that's what makes them this intangible asset, their moat and patterns. I think this is when more. I think I've only talked about patterns in a little bit more detail recently because of the HIMS case and things like that. But these things are intangible assets that can actually become a moat for the company, as well as regulatory framework, right? So if there's certain regulations around certain businesses, it may be hard to. It's going to make it hard for new entrants into the market, right? And then after that, we talk about revenue in terms of how the revenue is growing. We want it to be growing faster than the TAM, and we want to see customers switching over, right? So revenue growth bigger than TAM. Yeah, oops. Oh, I just realized spelling mistake. Give me a second. Yeah, so we really want to see revenue growth bigger than TAM. I think, oops. What? What's wrong? Oh, I don't need the equal sign here. Okay. Yeah. So we want to see revenue growth that is bigger than TAM. And I think the reason for that is we want to know that the company that we are investing in is actually taking market share, which means that it has to grow faster than the market that it is operating within, right? And I think because of that, let me go over here. Revenue growth. Okay, so this is, do we change it? Yeah. Okay, so optionality, which is basically the number of different verticals that the company can expand into, whether or not they're dependent on one single product, and then with no other site of new verticals to be built in, or are they like a company like HIMS, right? So HIMS can go into sexual health, they can go into mental health, they go into hair loss and things like that. And so because of that, it makes HIMS to become a company that have multiple scalable revenue streams. Now, some people may argue like there are certain, like their core businesses is not doing as well as certain new verticals like the GLP ones. And I think the debate about this GLP ones, as well as whether or not their core business is actually growing, is why certain people may score the companies differently over here. So it really, really depends. I think as you pick, so this number would change, you automatically score everything from you. And that's essentially what I'm building out. And then we want to see increasing margins, increasing operating leverage. I think this is nothing new over here. And then now, yeah, where we're at is actually debt and goodwill. So goodwill is basically we don't want to have goodwill more than 30% of assets. And I think that's a fairly healthy balance sheet, as well as manageable debt. I think if you're talking about debt, I mean, there are certain solar companies that went bankrupt because of the way they manage their debt. I think as recently as today, right? If I'm not mistaken, Beyond Meat actually filed for bankruptcy, right? So yeah, I think how a company manages that is actually it's not fairly important. It's actually very important, so that they actually have more cash than debt, right? So I think I need to be a little bit more specific. So okay, so the highest tier over here would be that they have net cash or low debt with goodwill less than 30% of assets. And I think again, like I said, I'll score that accordingly. So let me break it down. Copy this will go to the back over here. Let me just paste it. maybe we should just call this balance sheet, right? And then this will be here, management. Okay, so we know this. Should I put it together? I think it's possible for company to have manageable debt. Or maybe I should, never mind. You know what? I'll make the change later on in the week or over the weekend. Yeah, I'll make the change later in the weekend. But I think what I'll do is rather than to just say net cash and things like that, I'll actually use the debt to equity ratio. Or yeah. Now, let me think about this because you see when I invested in Palantir, I just know that they have more cash than that. I didn't really, to be honest, I really didn't have a specific ratio that I was looking at. These numbers, 30%, 30 to 50, 50% are numbers that, when I read certain books and things like that, these were the suggested numbers. It could be more or less than that, I think, depending on where you actually reference your numbers from. But I think, uh, yeah. But I think that is something to bear in mind. Why I want to write off goodwill specifically is because I think if you have seen certain companies that go out and make many acquisitions, depending on the price that they are paying for uh, the business that they're acquiring, usually they have to pay a premium over the valuation, the actual valuation of the business, and because of that, because of that, there tends to be a lot of goodwill that has to be later written off on their balance sheet. So I think that happened when SoFi actually purchased Galileo as well as Technosis. And I think back in 2023, you saw them actually wrote off a large amount of their goodwill. Because of that, they actually turned highly unprofitable in a certain quarter, right? So this is something that is just good to know. And I think Warren Buffett has said before that there are certain companies that like to buff their balance sheet by using goodwill. So if you're looking at it as total assets, I think that is can be quite an illusion if they have too much goodwill over there. So that's something that I will just do a little bit of a deeper dive. To be very honest, when I look at companies like Palantir, right? Or when I was looking at companies like Palantir, I was just all I was concerned with is that they have more cash than that on their balance sheet, and that because of that, even if they get into tough times, they may have lower profits, but they will not go bankrupt. And so actually, when you go into their 10K or 10Q, you can actually see how they actually structure their debt, and then I think right now, because they have more cash than that, they're actually using their cash, putting it into treasury bills, right, and earning a yield on it. So yeah, so because of that, I think let me think of how I want to phrase this properly, right? But at the end of the day, what I'm trying to put across over here is that when it comes to the balance sheet analysis, we just have to make sure company has more cash than debt. The interest that they're paying on the debt is not exorbitant as well, and that they have a in a way a payment plan, right? So I think a payment plan and things like that could be a little bit more complicated for the regular retail investor to understand. It took me quite a while to understand the convertible debt deal that SoFi offered previously. So but either way, it's still something that is important for us to pay attention to. So now here would be goodwill. Let me put less than 30% of total assets. And then I'll just copy this. And then goodwill is 30 to 50% of total assets, and goodwill is more than 50% of total assets. I personally don't remember ever seeing a company, or perhaps I haven't researched into that many small cap companies, but I really don't remember seeing a company that has goodwill of more than 50% of assets. I mean, if you know, happy to let me know down below. And then so same thing for here, 1.5, 1.5, and then we will work with that. Okay. In terms of cash flow, okay, this is not two separate categories, it's just one. I just want to see positive free cash flow. However, the asterisk over here is that because we are talking about strong compounders, right? So companies that are already in a position where they can continue to compound. Now, this doesn't mean they cannot grow exponentially. But usually, a lot of these companies still have negative free cash flow. So actually, if you take a look over here, uh, this particular checklist is for companies that, or at least how I try and look for companies that can grow and become multi-baggers over the years. Whereas this analysis, this Excel sheet over here is basically a checklist for strong compounding companies. They may not grow as fast. So initially, when I invested in Palantir, I never foresaw this rapid adoption of AI and then how fast they can grow to become 100 and they're what $180 today, right? So that was not something I expected when I invested into Palantir. I think I sat more on the side of the fence where they can be like a Salesforce type company. They'll eventually grow into that $200 billion valuation, but steadily over time. And and that's how I use this framework. Whereas what made me came up with this is because there were certain things over here, like the customer adoption velocity, which I saw in Palantir, which I didn't assess at first, right? But because I didn't assess it, in a sense, you can say that it was a little bit there was a little element of luck over there. I saw it as a compounder. Turned out it to be a company with a 10x potential. There were certain things that a company with a multi-bagger potential should have. Palantir had them, but at that point in time, because my research wasn't or my research process wasn't as nailed down as it is today, it was a little bit harder for me to notice that. Now, so that's for free cash flow. Second thing I want to point out is yeah, over here you can see this is NIM and the capital ratios for financial. So what I plan to do is that when I input a ticker symbol over here, I'll format this properly by Monday. Once I input a ticker symbol over here, it'll actually pull out the industry that the company is in. And if it is in a normal tech company, oh, I've just been told that you guys can't chat. I just thought that there's nobody talking. How do I turn on comments? Give me a second. You can't chat. Hmm. I just thought that it was a required day today. And that's why I keep talking. Nobody's asking me anything. Give me a second. Let me. I have a spy telling me that you can't click into my comments. Wait, give me a second. Yeah, okay. While I'm figuring this out, I can still talk, right? I think at the end of the day, you have to understand that the company that you're investing in, there's different metrics that work for different companies, and basically, I'm going to be using the net interest margin as well as capital ratios to judge a financial company versus free cash flow to judge a tech company or a software company, right? And then in terms of insider alignment, of course, we are talking about the CEO, like Anthony Noto. He's definitely not the founder, but he's mission focused. Um, and this is where I struggle a little bit because if you read investment books, they will tell you that founder-led companies are more mission focused. But if you consider companies like SoFi, SoFi is not founder-led, but I don't think anyone can say that they are not mission focused. And so to me, that having a clear vision and mission for the company and being focused on achieving the mission, it's a lot more important than being led because, well, SoFi's founder was, I think he was ousted for being a little bit too much of uh yeah, a party boy, right? And things like that. And the culture wasn't very good at that point in time. So, I think usually founder-led companies tend to be better, but that is not always true. For example, another company that we'll be talking about, Oscar, used to be founder-led, but the founder realized that his capabilities was actually better served focusing in improving the tech platform that they have, which is exactly what he did. So he actually got someone else in. What was his name? Bertolini, right? To become the CEO because he had the expertise to lead an insurance company while he can stay in the background, still on the C-suite, but to manage the tech platform instead. Give me a second. I really need to learn how to. Oh my goodness. Yeah, I see that there are 6 of you here. Can nobody type anything at all? Let me try it on my own. Let me try it on my phone. Give me a minute. Oh, I don't even see the. Okay. Okay. Give me a second. Last part, and then before we go into my X show you my X post. So just bear with me over here. Let me just finish this. So the last two parts after talking about insider alignment, has to do with buying back shares as well as institutional ownership. Um, the last two sections of this is actually basically risk management as well as the longevity and anti-fragility. Now, if you are finding that the word anti-fragility is very common or is very familiar to you, you might have come across the book Anti-Fragile by Nassim Taleb. And basically, the main premise of the book is that you want to do things, or you want to buy companies in a way that, you like business models, right? Of companies that don't just that don't just, in a way, how do I say it? I think he's I can't remember how he actually splits it up, because this was a couple of years ago. But he basically says that robust companies are companies that are actually able to maintain the same level of performance in any form of volatility or uncertainty. Whereas an anti-fragile company, not only do they actually defend their market share, defend their position in times of volatility, but they are able to actively take advantage of market uncertainty, or in terms of volatility and things like that, to actually grow the company. And SoFi really, really fits into this space, because if you take a look at companies like Upstart over the last couple of years, high interest rate loans, demand for loans actually came down. And because of that, you can actually see Upstart's revenue start to plateau and even decline in certain quarters. However, when it came to SoFi, yes, they were doing loans as well, but their management was able to pivot in such a fast manner, driving growth in the financial services side of their business, building out new verticals of their business, even in a tough environment. And for me, that is an anti-fragile company. In terms of longevity, we just want to see them have a track record. So this would definitely penalize companies like SoFi, unfortunately, because SoFi will not be a company that has more than 10 years and multiple cycles of and survive multiple economic cycles. Thus far, we can say that they have survived one, and they have only been operating in around 5 to 10 years. So it will be things like that. Risk management, I haven't really thought of how I want to label this. So, for example, if you look at our economic mode, you can actually see that there are three types, right? The mode is either fully built out and strengthens in volatility, or it's strengthening, clear mode, not insurmountable, which means it's pretty strong, but I mean, given time or money, other people can replicate the same mode, or it's just not a mode. So I actually did this scoring over here, I would say, based on SoFi, and I would think that for a lot of the companies that you are investing in, or I am investing in, smaller companies tend to not have a fully built out mode. Who has a fully built out mode? It will be companies like Nvidia, companies like Google, Meta, Amazon, and things like that. So switching costs, strengthening, yes, with SoFi Plus, clear moat over there, especially if you are within SoFi's ecosystem, but not insurmountable, because I would say companies like Robinhood offer something similar. Network effects, I think SoFi is too small at the moment to say that there's any clear network effects over there. So that's why I give that a zero. Low cost advantage, right? SoFi, we know they are using their own platform, their own tech platform. They have just transited most of their banking core over to Galileo, and because of that, you can say that they have a low cost advantage over their peers. Now, why is this not mode fully built? Because I think Galileo still has a lot of different features that they can add on to fully power SoFi, and I think right now is just a very basic integration. So strengthening clear mode at the moment still not insurmountable, right? Economies of scale. I think this has to do with their loans, right? I think you can see that because they originate a high volume of loans, because people trust their underwriting, they were actually able to um, have a little bit of a pricing tension when it comes to their loan platform business, and to get a higher take rate. So this is only because they do a large volume of loans at scale, and people want to originate loans through them. Now, intangible assets like brand, things like that, I would have to say no to weak mode for SoFi. Again, similarly, because When it comes to SoFi, I mean, their management always like to talk about what's that, unaided brand awareness. But I have no idea how they measure unaided brand awareness. Like honestly, I've asked my friends that live in the US or they go to the US for work and things like that, and I would say that only one couple has told me that they've heard about SoFi. Now, one of my friends was very nice. He went over, he knew I invested in SoFi, took a picture of the SoFi Stadium for me, and that's about it. Regulatory framework, I say this is a strengthening and clear mode, not insurmountable, because they have the banking license, right? So, because they have a banking license, I think it is a mode for them. Now, some people may say that because of the banking license, they are not viewed as a tech company. But I mean, look at the price of SoFi today, right? I don't think anybody is worried about their multiple today. It has already been proven that even with a banking charter, if you can deliver the growth, uh, through other areas like financial services, the market will award you a multiple. So that's how I think about it. And basically, I'll be doing the same over here with risk management. So this is also a concept from Nassim Taleb's book Anti-Fragility, where you actually want to decrease risk, right? So, however, I'm very well aware that there are certain companies out there with so for example, exit low margin unprofitable segments, right? So for companies like Palantir, I guess you could say that when they divested from their specs and things like that, that could be exiting unprofitable. It's not really a segment of their business, but it was something that was was hurting their balance sheet, basically, right? Or simplify and de-risk operations. So my point is that there are certain things in this list over here. For example, improve liquidity. Not every company needs to improve liquidity, right? So it doesn't mean that just because they don't improve liquidity, we can't score them well here. So I need to think a little bit more about the scoring system, where if it's not needed, perhaps we also give them a fairly high score. And like no unnecessary M&A that causes bloat. So for example, and again, this is one of those things that if a company doesn't do M&A, does it mean that it is a good thing? It's not necessarily, right? I just need to think of how to score this over here. So maybe if there is, we minus points, but if there isn't, we just take it as 0. I mean, that's something to consider. So I'll think of how to score this over here. And then, like I said, longevity and anti-fragility. Okay, so with that, let me try and fix the comment section. Give me 2 minutes. Comments on. No? It puts on. Okay. Can you type in the comments now? Is it possible? I think I see the live chat now. Let me test it myself. Oh, okay. I think it works. I think I see it. Must be something in my settings earlier on. All right, for those of you who have stuck around and watched me fumble over the last 45 minutes, there's just one last thing I need to do, which is to talk about my position in United Health. I think, like I said, what I plan to do with the live stream at the end of the day is to act as a way to document my thought process when I go through investing. Yeah, and so when I look back on it, I understand my thesis, because now I know why SoFi is a good company. I know why Palantir is a good company. I know why HIMS is a good company. But how did I get to that decision point? I can't tell you exactly how, which is what we're trying to do, right? Building that framework. back testing it, see whether it works. You guys have given me 10 companies, which I will evaluate over the course of the next 10 days. So starting from Monday will be day one, and there'll be the first company over there. And then all the way until 2 weeks later. I can't remember when's that. We'll go through the 10 companies, we will rank them, and then we might build a portfolio based on those 10 companies. If you like them, we might have a voting system, and then we see how that goes, right? Or we have certain tier lists, like two different portfolios. We will see how that goes, but that's essentially the idea. Okay, now I've done this. Okay, let me see. How do I share my X profile? Okay. Whoops, not this. All right. I think for those of you who stuck around, I think a couple of days ago I made this post, and I said that this is going to be day one of documenting my $500,000 portfolio. Here's how it's going to work. So basically, it's a lot of what I've spoken about before at the start. I'm not even sure whether the people watching this know what is STI and VCOM, which is WJP. So basically, these are Singapore companies, especially VCOM. It's a car company. It is, I think, the biggest in a sense. I would, is it car workshop? I don't really know what they are. But as you see, I don't even know what they are. I just know that someone told me that they were a decent company. They have a monopoly in Singapore and things like that. So that's why I bought them. And basically, the idea over here is that my philosophy behind investing has changed over time. But I've never really documented. So last year, in June of 2024, I decided to sit down, condense what I've done over the last couple of years, and run an active management on a portfolio. I think this portfolio was only about 30,000, around 30,000. So at the end on 18th of June 2025, this portfolio basically returned 36.3%, and you can see at the bottom over here that the S&P only returned around 9.5% during the same period of time. So we did actually fairly well. We actually beat the market by quite a fair bit. And so this year, with this $500,000 portfolio, we are basically going to hopefully do the same thing. Now, there's one caveat with this portfolio, is that because I'm actually using this the options income from here to actually fund certain parts of my lifestyle and my business and things like that. So not only do I have to grow this, I have to be withdrawing money from this portfolio every single month, right? So I just made a couple of withdrawals recently, and despite that, I think the portfolio is doing okay, right? So that's on the first day. Then on the second day, I think okay. So this is on the second day. I spoke about HIMS. I think people were worried that Andrew Dudum was selling shares, but like I said, he was selling shares up to 2% of his entire holdings. It's like saying someone having 100 shares and they sell two, and then you accuse him of losing conviction or dumping on retail, right? So like I said, I think people who are angry perhaps bought HIMS in the 60s and 70s, but I think you have seen my first video last year when I bought it around $18, and I bought quite a bit at $18. Since then, this company has 3x. So even at $50, $45, $50, I don't think anybody is dumping on you, and I don't think we really have to have such a big reaction towards him selling 2% of his portfolio. CPI came in, so on and so forth, and then okay, where was it? Day two. Okay, so day two is over here. Like I said, I wanted to talk about HIMS and how I actually decided to diversify part of my portfolio around HIMS because of their earnings call. And so the first thing I actually documented is that, when I looked at the numbers that they put up, their core business isn't growing as fast as I would have liked, and there's definitely a greater chance of a lawsuit now than it was back when they released their first quarter earnings. And then my current holdings, which is 1,000 shares at $44.68, and then I have $80 call, and then I also have a $45 put expiring on 19, both expiring on the same time, 19 September 2025, right? So on the day of earnings, I also show you over here that I actually sold 500 shares at around $61. And if you have followed my YouTube videos in the past, you would already know um, that I realized profits, I think, in the $51, $52 range previously, right? This was after my first buy. So I bought it at 18. I trimmed most of the position at around $51, $52. Got back in the low to mid 40s, and I started buying between $42 to $48 after Novo Nordisk actually announced their basically that they're going to dissolve their partnership with HIMS. That's when I started buying again in the $40 range. And so what I did exactly on day of HIM's earnings, basically I actually sold 500 shares off and took that money off the table, and then used that money as collateral. Oh my goodness, my English. As collateral. So 10 puts on that at $2, and so that's where we stand today. Now, of course, you can see the value of the puts here is incredibly high. It's higher than what I was paid. So basically, we're making a loss on the puts itself right now, but it doesn't matter because I want to buy HIMS in at $45, right? So basically, I said over here, there's going to be a couple of things that can happen. Now, do you make videos about how you use options? Well, I plan to, definitely. Although the main focus here is to help you find companies that eventually you can use options on, for sure. I don't really use options in the sense of buying dips and things like that too much. What I tend to do is I run the wheel strategies after finding quality companies. So if that's what you're looking for, then yes, for sure, I'll definitely be doing that in future. Perhaps using the live stream to explain it so that you guys can ask more questions as well. So yeah, I had 1,500 shares of HIMS at around $44. I sold 500 away, so that's why we are left with 1,000 over here. This is just the screenshot of the sale, and on the same day that I made the sale, I actually sold 10 puts at $45. Not the same day, sorry, just a couple of days after that. Right, after HIMS started to drop back down into the $51, $52 range, that's when I sold 10 cash account puts for $2. So that's how we ended up in this position over here. The call at $80 expiring on 19 September, and the put also at $45 expiring also on 19th of September. And then I break it down over here. There are three possible scenarios that can happen, right? If HIMS stays range bound between $45 and $80 between now and 19th of September, then I keep the $6,010 in premiums as well as the 1,000 shares that I still have. Right, because I started with 1,005, I sold 500, and then now I have this covered strangle across this position. Now, if HIMS falls below $45, that's where I get to buy another shares at a adjusted cost basis of $42.98. How do you get $42.98? Is because the 1,000 shares that I'm supposed to buy at $45 over here, for that I actually received $2.02, right? So you net that off from the price of the shares, you actually pay $42.98. If HIMS gets to $80, I'll sell my remaining 1,000 shares and basically turn a $67,000 investment into $100,400 in 3 months. Plus, I get to keep the extra $6,000 in premium. So it'll be $106,450. $106,450. Right, so that's a 73% return in 3 months. And basically, because I like the company, I still want to own HIMS, I'll just turn around, use the cash that I just received from selling HIMS at $80 and sell, cash account puts on this position, perhaps in the 60s and 70s until I get a sign again, because no stock ever goes all the way up. So to me, this is a situation where I'm not too bothered. If it's range bound, keep the 6,000. If it falls below, I get to buy HIMS at an average of $42.98, which is lower than my current average. And if it gets to 80, I make a 73% return on my money in 3 months, right? And I'll just use that money to sell puts on the company again. So, like I said, if you thought that was all, the fun has just begun. Okay, that's just a little bit of rhetoric on But basically, if I click over here, you can see I actually have this table. If you have followed people like Amit or TJ, the Wheel Deal, he has his wheel tracker, I believe he calls it. This is actually my condensed version. It's a lot bigger than that. I can show you. I think maybe I can show you over here. Okay, later I'll show you because now I'm on X. Then I'll just switch screen again. And right now I actually suck at switching screen. So I will switch the screen later for you. But basically, I have this wheel tracker. What it does, very simply, over here, this is the amount of invested capital, right? I actually have a table on the right-hand side, which I've hidden the cell, where it tells you, it factors in how much you have bought and sold, right? So for example, that's where you can actually see how much. So basically, sorry if I'm not clear. I sold 500 shares of him at $60.90. That's how I got this $30,450. Out of this $30,450, $8,110 was very simple, right? And then why am I doing this? Is because eventually I want to own the shares at a $0 cost basis, which is exactly what I've been doing with Palantir. Now, second thing, you can see the next two numbers over here. This is realized and unrealized premiums. So I actually track the status of my premiums. So you can see I've been doing it from 23rd June all the way until today. Or the latest time that I did it was actually 6th of August. That's when I sold 10 cash secured puts at $45 for $2.02. So you can see these are the two contracts that I showed you that are open. And so basically I've been tracking that. And so if you see right now, after realizing $11,300 in premiums since 23rd of June, my actual cost basis is $25.26. So if I buy an extra 1,000 shares at $42, it really doesn't bother me, right? Because my cost basis is already in a very healthy position. Yeah, so that's that. And then yesterday, I spoke about United Healthcare, which is basically, you can see it on today, the title of today's video as well. Yeah, I think I'll compile day 3 and 4. I'll try and summarize what I said in the post on day 3 and day 4. Right. So on day 3, basically, let me see. Oh, okay. So on day 3 of tracking my portfolio, that means on Wednesday, I actually noticed that United Health, because it went up, the options contracts went up 56%. Now, the thing is, I think I've explained it over here. I hope it's not too complicated because I did this whole Excel spreadsheet to try and understand the rolling of the contracts, and then after that, I accidentally deleted it. Okay, but basically, you can see over here, I bought 25 leaps for UNH expiring on December 2027. This was after rolling out of June 2027 leaps, right? If you want me to go into the details, I can go into the details in future. But basically, the point is, my original cost basis was 20 leaps, 20 June 2027 leaps. Those were at $32.70. They fell to $15.05, which means when I sold this 20 June 2027 leaps, I actually received $30,000. Now, at this point in time, I had two options. I wanted to take another $15,000 and buy the dip to average down. But I did the math, and like I said, I realized it made a lot more sense if I were to just cut my losses. That means sell, take the $30,000, add that $15,000 with this $45,000 to buy December 2027 leaps, right? So, and that actually buys me an extra 6 months for the thesis to play out. And so, because of that, today I actually sold, not today, back on Wednesday, I actually sold 5 contracts at $32. Now, why? Like I said, it's not because I think UNH is a bad company, but I've learned my lesson from previously being ill-disciplined, not sticking to my original capital allocation strategy. You see, this $15,000 was not meant to be allocated into UNH. It was a strategic move in order for me to lower my cost basis and make it easier for me to break even. I wanted to use it to continue selling options. Now, however, after I used this $15,000 to go and buy the dip, I actually managed to buy 25 contracts instead of 15 contracts, which means even after selling 5 contracts, I still have 20 contracts left expiring on December 2027, which is 5 more contracts than I otherwise would have had if I didn't use this $15,000. So to me, selling it, helps me to stick to my capital allocation strategy of only having around 10% of the portfolio in United Health, frees up capital for my real strategy, and frees up capital to buy companies that have shown weakness in price action recently. So this was back on Wednesday, right? Then on Thursday over here, Warren Buffett took a stake in United Health. This brought the company up to not brought the company up. He basically took a $1.6 billion stake in United Health. I believe he bought around 5 million shares. So, like I said, a couple days ago, took out 15,000. On hindsight, it may look very stupid because, it's just a couple of days. Now, back then, I'll be very honest, I never ever thought about, I knew at the back of my head that Warren Buffett was going to review a position on Thursday, right? And I think in all likelihood, a lot of us expected it to be United Health. And of course, hindsight is 2020. I should have waited until Thursday. It's very easy to say that, but I was trying to be logical because I have gotten burned using options before. So I explained over here in the past, I put myself in a similar position with PayPal when Alex Chris took over. However, instead of buying leaps 2.5 years out, I bought leaps that were 6 months out. And each time the company stayed flat or go lower, I would actually average down my leaps instead of roll them, which is why I decided to roll the leaps in the first place. Now, at the point of time when I did it, the portfolio was only at about $120,000, and I had $36,000 in PayPal's options, expiring in 6 months, mind you. So, and in the end, what happened is that directionally, I was right, because if you take a look at the PayPal chart, eventually they got to the $90 range. Let me see. Yeah, eventually they got to $93. But by then, it was December of last year. But my contracts actually expired in June, I believe. Yeah. When did my contracts expire? I started drawing here in 2023. Okay. I believe my contracts expired either in April or June, where they were still hovering in the $50, $60 ranges. And so because of that, despite being directionally right, because I was wrong on time, right? My leaps basically expired worthless. Now, of course, I didn't wait until expiry. Took the hit, closed them out. I think I only, out of the $36,000 I had, I only managed to take back $2,700. So I already learned my lesson from being over allocated, number one. Number two, from not rolling out my leaps. And at the same time, I think position sizing is very important. So, like I said, when it comes to United Health, it's not that I'm bearish on the company. It's just that because I already know that eventually I'm going to want to take out this $15,000. Now, at the point in time, I totally forgot that Warren Buffett was going to announce his holdings on Thursday, which is why I actually realized it earlier. But at the end of the day, you know, I think emotionally it's really easy, like I said, to feel like you should have done this, you should have done that, right? But objectively, the reason why I chose to take out the capital is because I've already increased the number of options contract that I would have otherwise had, right? If I had $30,000 and I bought the contracts at $20, I would only have 15 contracts. However, today I have 20 contracts because I used this extra $15,000. So to me, there's no point risking the capital because we are only making the best decision that, okay, let me not read from this. Let me just explain it again. And I think at the end of the day, why I make this decision to take out the $15,000 is because I want to actually prepare my portfolio for a seasonally weak, 1.5 to 2 months between August and September. And I'll use that money to buy other companies that I have higher conviction in. Now, I have high conviction in the turnaround story for United Health, but it's not a high conviction company in the long term for me. This is a 1 to 2 year position. So this extra capital that I took out helps me to roll my leaps out in an extra 6 months. And then it also gives me the ability now to once again use this capital as collateral to sell options on this, right? So I think that's where we stand at the moment. Today, I'm actually thinking about realizing a little bit more profits from this and completely take out my entire capital. Now, the reason for this, like I said, because this portfolio, it's not just about growing the portfolio, but to use part of the portfolio to pay my income. And so because of that, I think, this basically gives me the ability, because I've already doubled the position today, to actually use that to actually start paying my income. and to just not worry about it for the next 6 to 8 months. So that's something I'm thinking about. But yeah, and so that's where we stand. But like I said, on Monday, what we'll be doing is that we'll be going through the framework. We'll be looking at the 10 companies you guys have asked about, and then from there we will see where that takes us, how often we can do the live stream and things like that. And with that, I'll see you in the next one.